Welcome to the Business of Property podcast. I'm Simon.
I'm Stuart.
And I'm Simon.
We talk every week about the reality of running property businesses. Stuart runs a portfolio of co-living properties with a six-figure turnover.
And Simon owns Buy-to-Lets and created Patma, a leading portfolio management software system and a source of property market insights.
And Simon Glastonbury is an independent mortgage broker with 25 years experience providing mortgages, bridging and development finance for home buyers and investors. And my quick ask at the beginning of this episode is please do open your podcast player of choice and leave us a 5-star rating. We really would appreciate it. Now, at the end of this episode, or towards the end of this episode, we are going to have our normal quick-fire mortgage rates sort of round. Simon has got all those prepared and ready to go. But I think the biggest thing on Simon's mind at the moment is property fall-throughs and chains falling apart. So let's kick off with that, Simon. What's your current experience?
Hi, guys. Good to get back on again. Been interesting since we last spoke. It's a common theme at the moment. We can't quite put our finger on as to exactly why these fall-throughs are happening. A lot of feedback from agents is that it's people are finding it a little bit more difficult to get mortgage offers. That's not quite my experience from the front end, although with the rate increases and the sort of quite sharp rate increases we've had over the last few months, which we are starting to see drop again as people see in the media, affordability obviously has become more of an issue. But perhaps it may well be a case of people just looking at their monthly payment now. And if they'd started looking a year or so ago, they would have been basing rates around about 1%, 1.25%. Of course, if they've getting mortgage offers in the last 6 weeks, they're looking at rates well over 6%. Your monthly cost is worlds apart. So we can guess that's one of the reasons. If you look in your local area, certainly not the amount of properties which were on earlier in the year. That could well be the reason. But it's we're certainly noticing chains are falling down a lot more often than we would certainly expect them to.
Can you give us a sort of rough idea of how common that is? I mean, more than you would expect is it's obviously concerning, but is it sort of, I don't know, 1 in 10?
No, it'd be certainly more than that at the moment. With regard, I haven't got the exact figures, but if I took an educated sort of guess at the moment, you're probably looking at somewhere around 30-40% of chains falling through at the moment. You're always going to get chains falling through. That's commonplace, even at the height of the market when people are fairly sort of desperate and will do anything to get the mortgage and get the property on. At the moment, obviously, that's very different. People are using lots of different excuses, I believe, than to just decide, no, we're not going to go ahead. And also the potential, and we've been talking about this for a long time, the potential house price drop. That's always been looming around for everybody. Oh, we're waiting for this huge drop in the housing market. It hasn't really come. We've probably been talking about it for 10, 12 years.
That's a good question, actually, Simon. Have you had anyone that's mid-purchase ask for discounts?
Yes.
Recently?
Good point raised, Stuart. It's yes, absolutely we have. And to be fair, I encourage it. It's if they're in a good position, if they've paid top price for that property, they are then being stretched for, I'm seeing it from clients I have where we're stretching the mortgage out for them. They're thinking, wow, this is a lot more than I really wanted to pay. And you go back in, nothing lost, nothing gained. If you go back in and say, well, actually, I want another 5% off. I want 10,000 off. It's all monopoly money, isn't it? When you're talking about it. But of course, you at the end of the day, they have to pay this money off. But yes, absolutely, that is commonplace, and you're seeing it all the time, which is it's a pain all around for everybody involved because all the mortgages have to be changed all the way along the line. Memos of sales have to be changed along the line. Solicitors, so the whole process it's a bit annoying, but it keeps the chain alive.
Yeah, I was just going to ask about how much is actually involved in that. But you've already said a little bit. Does that sort of tend to sort of reset things with the mortgage lender as well, as in you have to sort of start again with their application process? Or
another great question, Simon, because we've had this. I had this earlier on, or a week or so ago, with one particular lender, and with a lot of the mainstream lenders, what you do is you just put a substitute property form or substitute property information. You give them that and you change it over. If they do change a property, if they change the loan amount, most are absolutely fine with that. You've got no issues. Got to watch out with a couple of the lenders. If you put a new property in, if you change property, they won't let you keep the existing rate. So that can be, that all of a sudden I had someone who was on 4 point something, and they said, that change fallen through, wasn't their fault, couldn't do anything about it, had to find a new property, found a new property, then we're on a 6.25. It makes a huge difference. So yes, it can. And of course, then that's a decision they're making. Well, do we want to buy? Do we want to move? So things like this are, there are lots of reasons why. And it's certainly, as we said briefly before, interesting to see the estate agents who I do have a good relationship with. They're nervous at the moment because they know the market is very, very quiet. They know it's very difficult to value property. We then go on to down valuations, very common in the marketplace at the moment. They're usually common in the remortgage market because it's generally quite easy and it doesn't matter as much unless you're really stretching out loan amounts. But in the purchase market, they're becoming commonplace, which is not something we see very often.
It does point to, and we touched on this very, very briefly before we hit the record button, but it does point to, that there is always a lag in the market because right now, if you go online to buy a property, it will just say sold subject to contract or, sale agreed or whatever. But actually all of these things that you're talking about are happening, so it'll be sale agreed. However, rates have changed, something will have fallen through, and that's just taking some time. And I think with all of this, and Simon P and myself talk about this often on this podcast, is that although it feels like there's not huge amounts of noise in the marketplace about the market dropping, based on your anecdotal evidence and kind of what we're seeing in prices, it does feel like there is a little bit more momentum behind the fact that the market is slowing down and people are getting a lot more sort of hesitant because these properties will eventually come back onto the market if they fall through. And, will people want to pay the same prices? The interest rates, which we will come on to, but even if they are dropping slightly, are still, 5 times higher at least than they were, this time a year ago. So, it does feel like this slowdown is trying to pick up pace, if that even makes any sense. But, it's helpful to have your anecdotal evidence as well.
Yeah, the slowdown is getting faster.
Yeah, you're absolutely right. It's a good point, Simon, that the slowdown is getting faster because it for whatever reason, it is definitely slowing down. I mean, I suppose how you can look at it is if properties like you say, Stuart, if they're coming back on the market, generally what you'll see is they'll come back on the market and maybe they're 10% lower than they were originally asking. If they are, people don't like to reduce their property price. That's across the board. I've been in this a long, long time. And what you do find forever, if they're told their house is worth X amount of money, they do not want to sell for any less than that amount of money. Very happy to sell over above that figure, but not below. So it's very difficult. And I do understand that from an estate agent point of view. They've got to work hard for that. But at the end of the day, if people are not going to pay that price for your property, it's only worth what someone's going to be paid for it at that time. And if there are less people looking, you are going to have to drop that price. But accordingly, in side by side with that is that you will pay less for the property you're going to buy. You then drop your price as well. Below you, drop their price. So it should marry up all the way along because everybody's pretty much in the same position with their mortgage and their mortgage rates and things. But Yeah, it's definitely happening. Something is happening. More and more, we're seeing week by week as a business, like all brokers, we're seeing people dropping off their 1.3, 1.4 rates, which they've had for an amount of time, and it's more so now. People are then ringing me up. My rate's coming up next year, which is unheard of. What do I do? What's happening? Where do I go? And people, because the media slowly starting to pick up on this. But I'd certainly think it's a little. I'm a bit more concerned about the property market than I have been over the last sort of 12 years. Since and want to put the 12 years in since the last crash, where we were kind of expecting, huge drops. I don't think there'll be a huge drop personally. If you're knocking 10% off a house price, what is that really? I mean, there's nothing stopping you putting that 10% back on in 2 months' time. It's all about timing, and it's all about getting the right person at the right time to buy your property.
Yeah, it's interesting because you've touched on that people are price anchored, and for the record, I said anchored. So that will change as the market moves forward. But interestingly, I've got a friend who's exactly the same, and I know that I'm very different to this. So I am very much someone who works in the moment. I never plan that far in advance. But I've got someone who says he's really worried about interest rates, and is genuinely concerned about it. Is phoning people, and I said, well, when's your rate up? Thinking he's going to say it's next week or it's next month. He's like, yeah, I think it's about a year and a half. And I was just said, and I mean, to the point of having sleepless nights about it. And I said, the world could look very, and I know it's easy for someone like me to say because I just don't, I'm not that sort of person. Whereas he is, so I kind of get it. And I had to work a different way. But I just thought, wow, so there are people because obviously I don't know what he got. Let's say he got a 5-year, because he knows that whatever happens, his mortgage payment will be still significantly high. But I said to him, look, all right. So I said, speak to your broker. I was thinking about you at the time. I said, speak to them. I said, but they're not going to know what the world looks like in a year and a half's time. They can just give you indicative. I think he just wants to model it out because that's how he is. But
yeah,
it's interesting that people are feeling like that because of what's happening in the news.
Yeah, I think that's absolutely right. I mean, I'm getting this all the time at the moment. I mean, people genuinely worried and so far out. I mean, it's just ridiculous. I mean, that you're right. I mean, you're sort of thinking, are you really concerned? And the common question is, well, what do you think's going to happen with interest rates? I would love to know what's going to happen with interest rates in 18 months' time, because I'd probably do quite well off the back of it. But I really don't know. And it's sort of, well, this is what, and you sort of give them in indicative terms about what, if we use rates as they are at the moment, this is kind of what they're going to look at, but you really don't know. And it's worrying times. And I'm getting a lot of that. It's probably the first time I can ever imagine this sort of scenario. I can't ever remember having to do this before, where people were so worried about rates. But you're right. I mean, they're jumping up 2, 3. The highest one, I think I said, the highest one I've had so far was on a buy to let, which has gone up just over 4 times. You can't put your rent up 4 times, although we'd like to. You just can't. So what are people doing? It's very different. Buy to let, I appreciate, it's very, very different, that market, to residential, but it's still businesses. You guys know it's a business. So you have to cost in accordingly.
Yeah, and having costs go up that much, I mean, it can be devastating. It's such a dramatic change, especially when a year ago people weren't expecting it. So they just won't have planned or thought through the consequences of such a potential change.
Yeah, absolutely. I've just got something here for you guys, which would be quite interesting, just so you can sort of give you an idea. A standard £200,000 mortgage, and you put that on a nominal 1.5% from 5 years ago, it would have been around about that sort of figure. Would have cost you £800 a month. So that's going on to a rate now is going to then cost you circa £1,300 a month. So it's a £500 a month increase. And for what? Just because of interest rates going up. Now, if you're at that sort of level, if you're PAYE, all of a sudden you have to find another £500. Plus, you have to find, we all know about what's happening with gas and electric and water and all the rest. I heard something today about car insurance going up by 50% or what have you. Everything around you now, like I say, if you're on a fixed salary, and that's you all of a sudden have to find probably nearly double your outgoings in some sort of circumstances, and that's why people are worrying. I think, and that's why. But you're not hearing an awful lot of it because still at this point, we're only seeing the start of people coming out of their fixed rates.
Yeah, and the point I was going to make is as well from a property business perspective, to your point around energy costs and everything else, we know, and we talked about this previously, even at the highest level, we know that inflation has been running consistently now anywhere between 8 and 10%. And you've just looked, you just given a basic example, which is, just close to a good average, where the mortgage payment itself in real terms has gone up by at least 50%. So we might, in our property businesses, increase the rents, and certainly my business, we have had to do that, which we didn't for years. But you cannot do that like interest rates. You can't every month just turn around and say, oh, sorry, we need to push the rents up again. You can do that once per 6 months at best. Most of us won't do it more frequently than once a year. And I think a lot of agreements will have that in place anyway. So you could only do that. Then most of us will be reticent to do that the following year. I certainly would, because I think, well, actually that feels fair. So, you might put your rents up by whatever the number is, 5 to 10%, but that's not even keeping pace with inflation at the moment. So that is why a lot of people will be worried. And like you say, there's a huge swathe of people that we know at the back end of this year will be coming out of their fixed term periods. And that's when I think, again, that this lag and the momentum will gather pace towards the end of this year, beginning of next.
I think you're right. I think also there to sort of jump on the back of that, you're working that out as with the eyes of your business. So you're doing it very sort of looking at the figures and saying, right, I will do this once every year, if at, like you say, at best, which is fantastic. I mean, I have very few portfolio landlords who do any more often than once a year. I've got one who will religiously put it up every single year without doubt. But most people are like you, Stuart, they don't, because you sort of think, well, I did it last year, I can't really do it again. However, it's the accidental landlords, the people who still have their first flat, or their first flat in a second home, maybe they've got a couple of buy-to-lets they've had for years. It's those people who then panic, I've noticed, certainly recently, going, this is ridiculous. All of a sudden, they've taken a little bit of money out to do their own extension, or they've taken a bit of money out. So they've sort of maximized their lending, or they're up to sort of 60, 70%-ish LTV. But now all of a sudden the rental is nowhere near going to cover the interest payments. So, and of course, there's also the tax issue they've got to deal with. And that's obviously a separate thing, which has then come in, which they're feeling the pinch on. So it's those people. That's the big question. What are they going to do? They physically can't put the rents up. What do? Are they just going to sell? Are we going to have a surge in market of sort of these types of properties, which are generally studios, 1-2 bedroom, first time buyer properties? We're going to see those on the market. I think you will. I think you will see a lot of those coming on the market in the next couple of years. Whether they can sell them or not is a different matter. That goes on to, but the accidental landlords, as I would call them, they're the ones who the figures are just not built in. They're not expecting these figures to be an issue.
So we've touched on stress rates and loan to value. So why don't we go there and start talking about the reality of where we're actually at with the rates, Simon?
Okay. Right, good point. I'm going to make your eyes water here, guys, because this is there's some scary rates out there. Although we've seen huge increases in rates over the last few months, and for everybody has their own opinion about it. We said off mic about the banks are just having a good time on the interest rate rises. They're all put it all over the media recently. They're dropping. It's very kind of them. But I think we're getting closer to the new norm. First of all, I just touch over the sort of the residential market, because that's kind of where people can see from their own sort of their own homes. You're looking at 2-year fixed rates at the moment, just under 6%. So there's a 5.99 out there for a 2-year, 5.39 for a 5-year. So I think that's sort of coming into the realms of that's where we're going to be. I think 2-year rates will come down a little bit, but I think that's a little bit more realistic. So if it's just over 5%, anywhere around there, I think you're probably going to do quite well. And I personally, I think it's going to settle around that sort of figure for some time. So that's kind of where we're going to be. There are still 95% rates on the market. For anybody who is interested, not great on them. They're 6.5% or 6.56 for a 2-year, just over 6% for a 5-year, 6.09. Tracker rates are still people like tracker rates because there's very low ERCs or no ERCs in some points. Again, you can get those just below the 5% mark. 4.93 is the best one on the market I can find at the moment.
On the residential mortgage side, are there fees involved in these?
The usual fees on the residential side, I know that's a favourite of yours, Simon, fees. Fees on the residential side are fairly standard. You're usually paid $995, $1,495 as a product fee, whatever they call it, whatever the lender likes to call it any one time, what their marketing team call it, arrangement fee, product fee, fixed rate fee. They're fairly standard across the board. Now, if I whiz over to the juicy side of things, the buy-to-let market. Now, yes, they've come down, and they're pretty tasty, some of these rates. So if you were Mr. or Mrs. Individual wanting to buy yourself a little buy-to-let, you can get yourself a 2-year fixed rate at 4.69%. Very nice, you say. But you've got to pay 5% as an arrangement fee. If you wanted a 5-year rate, it's 5.19%. Very nice, you say, for a buy-to-let. Simon, that's actually lower than the residential market. How possibly can you get me this fantastic rate?
I feel there's a but coming here.
I'm quite enjoying this, and I don't know why. It's horrendous. They're charging a 7% arrangement fee. 7%. And it goes on to limited company. It goes on to HMOs. Similar sort of rates, 4.5% on a 2-year rate, which is brilliant. Very good. But 7% fees on limited company and HMOs.
Wow. This isn't an average UK price, but you plucked a number out of the air, so I'm going to go with that. If you were buying a buy to let at 200,000 on a, let's just say you could get it at 75% loan to value, which is then 150 grand. 7% of that is £10,500.
Yes. All I can say is yes.
7%.
Yeah, absolutely. And this is commonplace. We have a sourcing system, as all brokers do, and the pages and pages of lenders, they've all gone that way. They've all gone, right, let's reduce the rate down. And I think what they've done now is if you look at it, and we've had this conversation before, the issue with buy-to-lets and the buy-to-let market has just died. The issue they had is the stress testing. The rates were so high, they couldn't, you were having to put 50-60% in as a deposit to make it work. And it just, people are not going to do that. Who's in their right mind is going to put that much cash into a property? It doesn't make any sense. So what they've done is reduce the rate down so the stress test works. So with the rental and the new rate, but okay, Mr. Mrs. Customer, yeah, we can give you that. Yeah, that works for you. You can get 70% in this case, but you're going to have to pay 7% for the privilege. Ouch. I mean, that really is. I mean, you've got to really want the property, or you've got to really want the remortgage. The remortgages are the same. Yeah, we'll give you this rate, but look at this, because they're trying to make it work with the rates they have. I mean, you could sort of switch off, and for a second, hats off to the lenders. They're trying to make something work, but that's the only nice thing I'm going to say about them.
Yeah, it's a good example of be careful what you wish for. As in the regulations came in and said you must make sure that you stress test what you're lending at, I don't know, 2% above your lending rate and 145% of rental cover or whatever. So the lenders are coming around and saying, okay, if that's what we've got to do, that's what we've got to do. And we'll just charge you 7% upfront in order to satisfy these requirements. So yeah.
Absolutely. Makes you wonder. It does make you wonder, doesn't it, when we're going to hit that. Is someone going to charge 10% at some point? I mean, we laugh, don't we? Because you think, no, that will never happen. I didn't think I was going to see 7%. I mean, that just, that blew me away. But if it works for some people and some people want that, and if you're already in the market, I just can't see how that, if someone's in the purchase, they're waiting to buy something, I just can't see how it works. Why would you? I mean, I'd have strong words with a client of mine who are looking to do that, and they'd have to have very, very good reasons. But if you're in the remortgage world, you've got to get away from your current lender for whatever reason. You need to raise a bit of money. Who knows? There's 1,000 reasons why you'd want to remortgage. Maybe that's the only route you have. Maybe that's the only option.
If you're stuck on a standard variable rate, it could become more appealing if you amortize it out over a number of years. But I mean, it just feels like daylight robbery. It does feel like, you said hats off. When you said hats off, I was thinking, hats off, masks on, because this is Dick Turpin territory, isn't it?
100%. Yeah, I'd agree with you there. I'm saying, I had to say hats off with tongue in cheek. I don't often praise them. It's they've come up with an idea, and like Simon said, they have these parameters they have to work towards. They can't not. The FCA put these things in place. You've got to make sure these stress tests. You've got to treat customers fairly. There's a new directive coming in, consumer duty, which is again because, in my view, treating customers fairly failed miserably. So they've come up with another idea, which is consumer duty, which is something we have to deal with. Again, trying to make sure the customer is looked after as best possible. And I do get stress testing, but equally, they've just literally slapped a 7% fee on there. If they're able, and it does beg the question, doesn't it? If they're able to offer a 4.69% 2-year fixed for a buy-to-let, what they're able to offer the rate, why do they need to put a 7% fee on it?
Yeah, it almost for me feels like it should be the other way around, because the longer the period of time, I guess, I suppose it just depends where their risk sits. But if you're offering, like you say, if you're offering 4.69 on 2 years, maybe they feel that their risk's lower because they're going to be out of it in 2 years. But just in terms of dotting I's and crossing T's, I should just mention that obviously the rates and the fees we're talking about are as of sort of 11th of August when we record this and when it goes out. And anything we talk about, which is mainly moaning and insulting the banks, shouldn't be constituted as any kind of financial advice whatsoever. Just thought I'd get that in there before we start wrapping up the episode.
Just a few short weeks ago, when we last spoke, we were talking about fees of around sort of 2-3%. So I'm just curious, assuming you can still get mortgages with only 2 to 3% sort of fee levels, what kind of interest rates are you then looking at for those sorts of products at the moment?
Blimey, Simon, you want everything, and it's not Christmas yet, is it? It's only August. Goodness me! I don't think the I don't think the product team at the lenders have thought that far ahead. No, absolutely. You're looking if you're there, you're looking at 5.5, 5.75 to get to. That's the kind of rates you're looking at on a buy-to-let side of things. In the normal world, let's put it that in the real world where we normally sit, that's kind of the rates you're looking for. But it's really funny because not funny, but I say nervously, it's when we're looking at these things, it's pages of 5%. 7% rates we're seeing in our sourcing system. So if you want something like that, you have to look a long way down before you start getting back to the normal rates. But they are out there. I think TMW have always been very aggressive in the buy-to-let market, and they have a wide selection of rates you can look at, and they go from the 7% to 5%, and then they'll go 2.9. They change often, but I think it's 2.995 and then 1.495 and then a 0. And the rates match up accordingly. So I think they're at around about 5.74, I think it is, for 1995. I don't have to double check that, but like Stuart says, these things change constantly, and make sure people speak to their brokers, because that's the thing. You can kind of, a lot of the good things at the moment, because we are seeing rates come down. If you do lock in, most of the lenders will, 99% of the lenders will let you just jump ship and get the lower rate. So yeah, that's what I would do. Constantly look at you and speak to your broker.
So just to round up the picture for this time, we've done residential, we've done sort of buy-to-let. Just to clarify, those buy-to-let figures, were they limited company or personal, or does it not really make much difference these days?
It's a good point, actually. It doesn't make a huge amount of difference these days. It did up until sort of the rate changes of, it was about 8-10 months ago, when we started to see the rates going up. Not an awful lot. They actually, strangely enough, the limited company buy-to-lets actually cheaper than a standard buy-to-let. It's at 4.54 with a 7% fee, of course. HMO 4.64 with a 7% fee, but they're a lot of them, and they have the same. There's a wide range because of this sort of new world of huge fees. You can change them; they'll go down, but they're very, very similar. Which is the first time we've seen them. They usually we've seen probably about a 1% increase. I would say very general there on over a standard buy-to-let. Now much of a muchness. And it's very interesting that they are actually, I appreciate the fee again, but I just find it very interesting that they're actually 1% cheaper than the residential market. There's something I would never have seen before.
You can't forget that fee, though. You can't forget that fee.
No one.
A few £100 versus 7%. I mean, of course, it depends on the property you're buying and how much it's buying for, but generally speaking, that's a big difference.
Huge. Yeah, and if you work that out, and even if you, like Stuart was saying, even if you work that out over 5 years, and you try and divide it up and you try and justify it, it's still a huge amount of money, isn't it? You just can't get away from that.
Yeah, definitely. All right, I think that's us out of time for this week. Thank you very much, Simon, for joining us and sharing all that fantastic mortgage knowledge. For anyone listening, if you'd like to get in touch with Simon Glastonbury, his contact details will be in the show notes. And other than that, we'll look forward to speaking to you again next week.